Why do some people retire with financial freedom and others struggle and scrape just to get by? I started working on this problem in 2010, and now it is April 2026, and I'm excited to share with you how I help investors achieve financial freedom by creating streams of tax smart income while growing equity for future generations. Hello, everyone. My name is Brad N. Reed, and I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. Welcome to Financial Fountain of Freedom, Episode 6. Today, we're going to talk about stock market order types and how to combine these order types so you can set it and forget it and go about your daily life and not worry about your stock trades, because you'll have a target. If it goes up and it hits your target, it'll get you out without even having to be there. And if it goes against you, you can minimize your loss without you having to stay in front of your computer or on your phone. Next week, we'll talk about candlesticks, gaps, reversal, and continuation patterns. And on May 6th, I plan to talk about how to build and test a trading strategy. That'll be a key one if you wish to achieve success in the stock market. So mark your calendars for May 6th, and I hope you come back for the next one. Ought to be about April 22nd. I am building a four-part series. We're talking about part 3 here, Invest for Success, Achieve Your Financial Dreams by learning to invest for yourself instead of paying someone else to underperform the market. Want you to learn to invest, want you to learn how to build businesses, grow many streams of incomes, and dominate your finances. It all is going to start over here in Tier 1, where you learn how to be good. And by be good, I mean get out of debt. If you've been with me for a few sessions, you know that as we invest for success, we're fighting against inflation. And if you're fighting against inflation and credit card debt and medical debt and student loans and whatever other debts you got, it's too tough of a battle. So get those debts paid off, with the exception of maybe the mortgage on your house. We'll talk about good debt versus bad debt, but well, I guess I got to talk about that now, right? The only good debt is when you take out a loan to pay for an asset that's going to increase in value more than the debt's going to increase in value. So, for instance, I have a loan on my house. My house is expected to appreciate over the long term at about 5%. Maybe I'll get a little bit better, but my loan is less than 5%. My loan is actually close to 3%. So in that case, it's considered a good debt by some. And when I have debts for my investment, my apartments, those are expected to grow at 15% rate of return or better, and the interest rate is significantly lower. So think about, if you do have a debt, can you sell the asset that the debt is on in order to pay off the debt if you need to? If you have credit card debt, there's probably nothing you can sell, like the dinner you ate last night, to pay off the credit card debt. So let's get out of debt, be good. And then stage 2 is about aligning your mind, body, and spirit. I read another book last week called The Tribe of Millionaires. And again, it says you are the average of your 5 closest people. If you are watching episode 6, it probably indicates that you have this calling to achieve financial freedom. Do the people that are closest to you, are they trying to achieve financial freedom, or have they already achieved it? Because if they are not trying to achieve financial freedom, or they want to depend on a company or a financial advisor or the government to provide for their finances, then maybe it's not the right people that you need to be around, and you might need to go find a new tribe of 5 closest people. It is in our DNA, it is in our brain, it is in our physical wiring to agree with and meet with your tribe, your closest people. Because 10,000 years ago, 100,000 years ago, if you did not align with your tribe, they'd kick you out and you died. But today, it is okay to leave your tribe if they are not going the same direction you are going. Tier 3, achieve your financial dreams. Tier 4, live your dreams. I know people that have 9-figure wealth and they are miserable because they think that they need more, they deserve more. Maybe they do. That's not my call. But the whole point is, once you have achieved your financial dreams and you have achieved financial freedom, how to live a life of fulfillment. How do you live your dreams? How do you give generously to your community? Spoiler alert, the key for happiness for those that have financial freedom is how they give. It's not what they get, it's what they give. So we'll talk about how to do this in a sustainable fashion. No, the answer is not to just give everything away. It's to give a proportion of what it grows and to keep it growing so you can continue to give and give and give and pass it on to future generations. All right, this is not financial advice. This is for education and entertainment only. Should you want personalized financial advice, please seek a competent individual in your area. I will be talking about real life investments and opportunities. I will be talking about taxes, accounting, maybe some legal stuff. None of this is considered advice. None of this is considered an opportunity to buy or sell. So go seek a competent, preferably licensed individual in your area should you seek that kind of stuff. Folks, interest rate matters. You have to outpace the cost of living. Inflation increases the cost of living. Another sidebar, I recently heard an advertisement that says, hey, look, if you do this, this, and this for your newborn child, when they get to retirement age, it'll come to $3 million. Now, $3 million sounds like a whole lot of money. But let's say your newborn child is going to retire in 72 years. Now, I know that may be a little bit more than current retirement, but let's just say at age 72, what is $3 million in 72 years? Well, if the median cost of income right now is $100,000, at 4% inflation, the cost of living will double every 18 years. So in 18 years, $100,000, it'll take $200,000 to provide that same standard of living. 18 years from that, it'll take $400,000. Am I doing that right? 100,000 today, 200,000 in 18 years. That doubles again to 400,000 in 36 years. That 18 years from that, it'll double again to $800,000. And then, yeah, that'll double again to $1.6 million for the cost of living in 72 years. So what $100,000 buys today, in April of 2026, 72 years from now, it'll take $1.6 million to provide that same standard of living. So a $3 million retirement, probably not going to do it. So you need to calculate your required inflation-adjusted rate of return and then compare that to your current strategy. Do you need to make a change or not? Because in 2010, I did this exercise and I determined that my retirement financial fountain of freedom looked more like a retirement dumpster fire. I'm going to give you my calculator for free. That is the link if you want to type it in your browser, or if you're watching this on YouTube, check out the description. It'll be in there. So this is what I'm going to cover. Or this is the standards that I think you need to follow. Money mindset determines your financial future. Remember, most people, when they dream about what they would do with their money, it's about buying stuff, spending it, and giving it away. Cars, houses, vacations, amazing life-changing gifts to people in need. But the problem is that they spend their money, then it's gone. The best money mindset in my view, if you want to achieve financial freedom, is to dream about investing in apartments and businesses and energy supplies, investing in things that create a stream of income and grow in equity, both of those two at the same time. They spin off streams of income and they grow in equity. And then with that income, you can buy your toys and you can go on your vacations and you can give life-changing gifts. But first, you got to plant those seeds to grow more sunflowers so that those sunflowers can give seeds, where you plant more sunflowers and eventually you have so many sunflowers making so many sunflower seeds that there's more than you can eat and you can reinvest and live a beautiful lifestyle of financial freedom. Calculate your desired rate of return. I had a fun conversation with a new friend named Letitia the other day, and she said, hey, Brad, we're trying to figure out if we need to stay on plan A or go to plan B. Plan B costs a lot of money. And so my answer to her was, well, what rate of return do you need to outpace inflation and achieve financial freedom? She said, I don't know. I said, here, get this calculator, figure it out with your husband, and then let's talk again. And so Letitia and her husband are going to have a meeting here in a week or so. Looking forward to that, Letitia and Letitia's husband. Then if you do need to go down Letitia's plan B, you need to find something different in what you're doing, I would encourage you to structure a great portfolio that follows the Ray Dalio's principles of being diversified with non-correlated asymmetric risk reward. That means each investment is diversified from the others. It's non-correlated from the major markets, and each opportunity has asymmetric risk reward. And then follow Peter Mallouk's asset allocation strategy of his high net worth individuals and families, which means the majority of it is in private real estate, and you've got pieces in private equity and energy, in addition to a much smaller proportion of public equities of stocks and alternatives. So Peter Mallouk's asset allocation, his high net worth people had about 20% in public equities like stocks and alternatives, and then 80% in private investments with a majority in real estate. And so that's what I've been studying mostly. Also, make sure it serves your needs for cash on cash and equity growth. If you are in retirement, you need cash on cash to provide for your lifestyle and equity growth to outpace inflation and your expenses. If you are before retirement, like me, mostly focused on equity growth. Indomitable and Horizons Funds has investments right now in April 2026. Swing on over to indhrs.com and learn more about us. Remember how we learn this 10% by reading and listening and watching videos like this. There's another 90% of the skill set that you need to acquire to be proficient in achieving your financial fountain of freedom. And you're going to do that by 30% with discussing with others and 60% by doing it. That's why the average of your 5 closest people needs to include either obtaining this skill or have already obtained this skill. So how I'm going to help in this series, we've already talked about mortgage tips and tricks. We're currently talking about stock market tips and tricks. Next will be multifamily knowledge, how to invest in commercial multifamily, and then we'll dive into private equity and energy. All right, so stock market things that will change everything. How to make money when a stock is going down. How to set your entry, protective stop, and exit and walk away. How to buy insurance on stocks that you own. I talked to someone this morning that's like, man, I really wish I could have protected the downslide in gold and silver. Well, I'm going to talk about how you can buy insurance on that. How to earn monthly income before buying a stock. How to earn monthly income before selling your stock. How to lock in your gains and stay in a trade. We're going to talk about trailing stops today. How to profit if the stock makes a move in either direction and you don't care. Was looking at Amazon yesterday. In the last couple of earnings, it's made big moves. What if you just placed one trade, and if it makes a big move, either up or down, you don't care, you make money? Wouldn't that be cool? How to collect steady income when a stock goes sideways. All right, last time we talked about an uptrend. Folks, remember, an uptrend is when you have 3 consecutive higher lows, not 2, but 3. You can draw any line with 2 points, but it becomes an uptrend when you can combine 3 higher lows. So what I do when I'm going to trade an uptrend or identify an uptrend, I connect the first 3 higher lows, draw a straight line. That's support. That's where I'm expecting the stock to bounce off of. Then I make a copy of that line and I move it up, and I call that resistance. And I mark where the stock tends to go back down. Then after you have identified 3 consecutive higher lows, you can buy low and sell high. Buy low, sell high. Buy low, sell high. Buy low. You may have lost on that last one, but keep buying low, keep selling high. The trend is your friend until it ends. Then you have to change your strategy. Maybe it starts a downtrend. A downtrend is defined by 3 consecutive lower highs. Remember, 2 points, you can draw any line, but when you have 3 points, you can draw a straight line, and in a downtrend, we call that resistance. You make a parallel line and mark where the stock tends to bounce. Then you sell high and buy low. Remember, you can sell first. It's not going to work every time, but the idea is if you have asymmetric risk reward and you're right 50% of the time, you still make money. If you win big and lose small, 50% win-loss ratio, and you are making buku bucks. Sell high, buy low, sell high, leg in again, buy low, do it again, sell high, buy low. All right, we talked about also you can make money in both directions if the stock is going sideways. Draw your support line at the bottom where the stock tends to bounce. Draw a resistance line where the stock tends to stop going up. Buy low, sell high, buy low, sell high, and then don't forget you can also sell high, buy low. Sell high, you might have lost on that one, maybe you're still in, but sell high, buy low, sell high, buy low. All right, we talked about what a stock is. It's owning a piece of a company. Remember that the price moves on what traders expect to happen next, not what has already happened. I get messages all the time. Hey, Brad, the stock moved. What happens? Doesn't matter. What happens next? I actually got well, I did get a call from Fox News one time, but that was a different story. They thought the New York Stock Exchange got hacked by terrorists. If you remember a shutdown back in 2017, 2018. But oh, I remember there was a big downward move in the market, and the news said the stock market is crashing because of a flu outbreak in southeastern Missouri. I have no idea why seasonal flu virus in a small part of our country would cause the entire S&P 500 to go down, but that just shows you how desperate news is to get clicks. The whole point of that is follow the stock, place the trade, understand what other traders are expecting to happen next. Quit worrying about what happened 24 hours ago, 24 months ago, etc. All right, a PE ratio is a common way to measure the value of the stock. We're going to talk again about the Shiller PE ratio. An ETF is a basket of stocks. A market ETF is a basket of stocks designed to follow a more expensive market index. So ticker SPY follows the S&P 500, ticker DIA follows the Dow Jones, ticker QQQ follows the NASDAQ, IWM follows the Russell 2000. So some of y'all are paying a financial advisor 1 or 2% in order to, and pretty much all they do is they create a basket of investments that follows one of these indices, except they charge you to do it. Whereas you could go just buy one of these ETFs and then you can just follow the index without paying the financial advisor. After about 20, 25 years, a typical financial advisor has more money than you do because they make money whether it goes up or down. They still get their 1% whether they win or lose, whereas you lose in the down years and you win in the up years. All right, and a sector is a group of stocks that are all in the same industry. So with the burst of AI recently, a lot of people are excited about investing in the technology sector. They don't know which company is going to be the big winner. So instead of picking 1, 2, or 3, they just buy the sector. Energy has been a big discussion right now because of the war in Iran. So maybe you don't know which energy company to buy. So you can buy the entire sector, or you can trade it, or you can buy options, or you can buy puts if you think it's going to go down now that there's a ceasefire. An analyst is a professional who publishes research and price targets on companies. Folks, these analysts are not always honest with you. They can be bought and paid for. For instance, just as a comparison, back in the 90s, I was trying to figure out what is the best thing to consume after a workout. One article, scientific article I read, said beer because it has alcohol that gets the lactic acid out of your muscles. It has complex carbohydrates and it has B vitamins. Another one said water because you need hydration. And another one said milk because it has protein and these other beneficial things. And then I looked at who wrote the article. Well, guess what? The beer company was written or sponsored by Anheuser-Busch, and the water article was sponsored by a water company, and the milk solution was sponsored by the American Dairy Association. Stock market is the same thing. This is, let's see, I got silver here. Notice how high silver is right up here. Have you heard people say, I know I got a couple of things, Brad, silver's going nuts. You got to buy silver. Look how high it is. Silver's going nuts. You need to invest in silver. Well, ever think that maybe the people telling you should buy, they're the ones wanting to sell? Maybe they bought silver way back here when it was in the 20s and it rocketed up over 100. And they're like, yeah, now is the time to sell. Same thing was gold. You remember the commercials from way back when? Buy gold, buy gold. Gold's rocketing upwards. You need to buy gold. Well, maybe they wanted you to buy gold because they wanted to sell. All of that to say, analysts are not always telling you what you should do. Sometimes they're telling you what they want you to do because it benefits them or the person that paid them to publish their article. Okay, brokerage company is where you execute and buy orders on your behalf. I use Schwab. This is my referral code. They give me a little extra love if you fund an account there. This link will also be in the description if you're watching this on YouTube. An exchange is where stocks are bought and sold. A market maker is a firm that stays ready to buy or sell at any time. All right, I gave up finding a graphic. I had to make one. I tried AI 3 different times. AI could not get it right. So if you saw episode 5, I noticed live during the recording that AI did not make the graphic correctly. So I made it myself. The bid, ask, and the spread. The bid is how much money you receive when you sell a stock or an option or a future or whatever you're selling on an open market. You receive the bid. The ask is what you pay when you buy your stock or your option or your future or whatever. The big ask spread is the difference between the two, and that's what the profit for the market maker for his or her service, or it, because they're mostly computers now. So over here, if you're the buyer and you want to buy this equity that the market maker is selling, the market maker sets the bid at $1. That's the ask. So the buyer pays $1 to the market maker, and the seller wants to sell at 95 cents. The buyer pays $1, the market maker takes the dollar and keeps 5 cents, gives 95 cents to the seller. The seller gives their shares to the market maker, and the market maker passes those shares on to the buyer. This is how it works for options, futures, pretty much everything that's sold on an open market. The market maker keeps a tiny amount. Now, if there's not enough sellers, then the market maker will raise the bid and therefore the ask in order to encourage sellers to sell to satisfy the demands that the buyers are lining up. The buyers are putting in buy orders, but there's not enough sellers. So the market maker increases the price. Similarly, if there's a lot of people wanting to sell, and not enough buyers, the market maker will lower the price in order to encourage more buyers to come in. So if you wonder why is the price going up? Why is the price going down? Is because the market maker wants more money. And the market maker feels, based on the orders that are placed, you might have heard of level 2 data, because of the orders that have been placed and are sitting out there, the market maker is going to lower the price or increase the price to get more transactions so that the market maker can make more money. If a market completely falls asleep, the market maker has been known to raise the price or lower the price to encourage more action. So it could be that both buyers and sellers are like, we're done. So the market maker can start monkeying with the ask and the bid in order to encourage buyers and sellers to start taking action. All right, again, review. I got to go faster. Shiller PE ratio. It is the third highest ever. Check out the Shiller PE ratio. Watch that to find out when stocks are of value or when they are way overpriced. Buffett indicator. Very similarly, we are way overpriced right now in April of 2026, even though the market has gone down some. All right, here's where we are in the big grand scheme of things. Most of you are doing buy market or sell market orders. And the problem with that is that you give the market maker permission to trade you at whatever flipping price they want to fill you at. And there is a massive amount of slippage going on, and buyers and sellers are getting a much worse price than what they should be. You may be aware that there are some free commission trades going on out there, and basically it kind of like your broker is front running you, which means they put an order out in front of you, knowing that your order is going to push the market maker in their favor. Sometimes that's very high level misrepresentation, but more detailed, the broker is going to a private market maker, not the big exchange market maker. And this private market maker or wholesaler fills you out of their own inventory of stocks. And the problem is the bid-ask spread is whatever they want to set it at. And it tends to be bigger. And you get a slightly lower profit or slightly lower, less favorable fill when you buy and sell. It also means that other people that are actually going to the market exchange or the exchange market maker, they're not getting the good bid-ask spread because of the volume. When the volume goes down, the bid-ask spread gets bigger. The SEC estimates this is costing us $1.5 billion per year. This strategy of the private wholesaler filling your order has been banned in several countries, and I think Robinhood got sued for a bunch of money. Go look that up if you think. But yeah, some of these brokers are getting sued for screwing the investors. All of the whole point of this slide is avoid market orders unless you absolutely need to. Going to revisit this concept again. Support is where buying tends to happen. It's where the stock tends to bounce. Those of you supply and demand people, I love you. You're right, but this is easier. When a stock tends to bounce and go up at a certain level, we're going to call that support. When a stock reaches a certain ceiling and it tends to stop going up, we're going to call that resistance. A lot of times when it hits that resistance, it goes back down. Sometimes it breaks through. Sometimes it goes sideways. Let's talk about that. The reason it's so important to identify this support and resistance is that when the stock breaks through, old resistance typically becomes new support. Old support typically becomes new resistance. Let's take a look at, I was looking at Amazon last night and I drew these three lines. Can I get some more time on this chart? I'm going to put some more time on this chart. Oops, not that one. This one, time frame. Let's go back 5 years. See where Amazon was 5 years ago. All right, so I'm going to highlight this area. And this is over 2 years. So notice how this peak back here in July of 2024, this resistance served as some flavor of support in November of 2024. It caused a brief resistance here in March of 2025, support in May of 2025, support in, February of 2026, and again in March of 2026. This old resistance proved to be a key pivot area for years to come in the future. Same thing with this support here. resistance there, support there, support, resistance, support, support, resistance. So when you can draw these lines and they hold for years, keep them on your chart. Don't have so many lines on your chart that every single up and down is a support or a resistance. But where are the major sections? Where would you want to sell at if you were in a trade? Where would you want to buy? Buy at support, sell at resistance until it breaks, then do it again. Next, I want to introduce the concept of having 3 orders for every trade. If you're going bullish, you're going to have an entry, a target up above, and a protective stop down below. Notice I've got 2R over here for the target, 1R for the loss. A general rule of thumb is that if you're going to win, try and win at least double what you might lose. If you're talking about a real estate investment over a 5-year hold or 7-year hold or 10-year hold, you may have heard me talk about MOIC, multiple on invested capital. And you probably heard me say, I want at least a 2x multiple, 2x MOIC for my investment. Same thing with my stock trades, whether I'm planning on doing a day trade and being in for a couple of minutes, couple of hours, or I'm doing a long-term play and I'm going to be in for a couple of weeks or a couple of years. I want to win double of what I lose. Same thing if I'm trading bearish. I want an entry, a protective stop, and a target. And I'm going to place, a little bit later, I'm going to show you, I'm going to place all 3 of these orders at the same time. So I've got 2 orders if I want to buy. Don't think enter right now, think buy. Because if I'm going bullish, I'm going to buy to enter and sell to close. Am I going to sell at my target or I'm going to sell at my protective stop? Buy to enter, sell to close, or buy to open, sell to close. Buy to enter, sell to exit. On a bearish trade, I'm going to sell first and buy second. So I'm going to sell to open and buy to close at my protective stop or buy to close at my target. Or maybe I'm going to sell to enter and buy to exit at my target or my stop. So a buy order, whether I'm entering or exiting, if it's a buy limit, that means I'm going to buy the stock or option or whatever equity it is at the price I set or lower. I'm going to buy at that price or lower. Usually lower means better. So if it helps you out to buy limit means buy at that price or better, that's fine. The other order we're going to talk about is a buy stop market. And what that's going to do is say, hey, the buy limit tells the broker, don't do anything until the stock gets down to my price or lower, and then fill me at the ask. A buy stop market says, hey, don't do anything until the ask gets to my buy stop price or better. And then once it does that, fill me in at the next market offer. So it's a little bit more complex. It's still putting in one price, the price at this orange line. And as soon as the ask gets to that level or higher, the market maker will fill you at the next market offering. Sometimes the market can jump and you get filled significantly further away than your stop price. And some people don't like that. And so they will only do a buy limit entry. The same thing on the bearish side. If you're going down, maybe you want to sell to exit or sell to enter. But if you want to wait for a stock to go through a certain level, you want to wait for it to go down, you can put a sell stop market. And that tells the market maker, don't do anything until the stock gets down to the price I set, and then sell my shares on the next market offering. Or maybe you bought low and you're going to sell high to exit, and you say, don't do anything until it gets up to my target. That's a sell limit. Don't do anything until it gets to my sell price or higher. And then it'll execute you at the bid. All right. So the way we use these could be on a breakout versus a retest. So let's say you only want to do a buy limit order You would wait for this stock to break through your buy price, indicated by the orange line here. Once it has broken through, you can then place your limit order to see if it's going to retest old resistance as new support. So you got to buy limit, just waiting. That order's just waiting, and it may wait for minutes, it may wait for days. If you mark it as good till cancel, it'll sit out there until it times out, which is usually 6 months or a year, or until you cancel it. And then let's say it fills, and it fills on the first time the ask is below your limit price, and you get filled at the ask, and then it goes up in your favor. So again, in this situation, you are waiting for the stock to come down to your limit price. The other situation is if you want to buy, the stock may be under your resistance and maybe it's going sideways and you don't want to buy until it breaks out. Maybe you're waiting to enter. And on the time where it does break out, it breaks across your resistance, you wait, you tell the market maker, sorry, you don't wait. You have placed your order. The market maker is waiting for the ask to meet or exceed your buy price, and then you get filled at the next market ask. Sell limit works the same. You can wait for the stock to break through the support, and you want to sell when it comes back up to your old support, and you place your sell limit. And then after you place the sell limit, once the price gets to your limit price or higher, you get filled and you sell your shares. If you're waiting for the price to break through your support, you can enter your order, and your order's just sitting out there waiting until the stock crosses below the stop price. And once it does, when the bid equals or exceeds your sell price, in this case lower, then you get filled at the next market bid price, and you hope it goes lower. So here comes a test. There's 1, 2, 3, 4, 5, 6 types of orders to place on the test. Pause the video, answer. I'm going to start going through this. Number 1, if you want to sell at this price or higher, the order that allows you to sell at this price or higher, in this case, higher is better. To sell at this price or higher, that's the sell limit. If you don't want to buy until it breaks through that resistance, maybe you put a price and you tell and that's telling the broker, don't buy until it gets to this price and then get me in at the next market order. That's going to be a buy stop market. Now you can put a protective stop in there at a support you have identified. And what you're telling the market maker is, hey, look, I don't want to sell until it breaks through this support because, hey, look, if I'm wrong and it triggers me in and then comes right back down, don't get me out until it breaks through this support, because if it breaks through this support, it's probably going to the next support, and I don't want to lose that much money. I am willing to risk 1R and maybe some slippage, but I don't want to sell until it gets to this support and then fill me at the next market order. That's a sell stop market. Over here, we're in bearish and it's going down, and you want to buy to close when it gets to the purple line or lower. So the order that says, hey, buy me at this price or lower, some might say this price or better, that's a buy limit. The order to trigger that says, hey, look, I don't want to sell until it breaks through this resistance and goes lower. So I'm going to put a price up there and just let it sit until it breaks through and then fill me at the next market order. That's a sell stop market. And then your protective stop on this kind of trade is you tell the broker, I don't want to buy until it breaks through this price or higher, then fill me at the next market order. That's a buy stop market. If this is confusing, back up the video and run it again, because this is important. Moving on to another way to place your trade. If you want to sell at this price or higher, what type of order will sell at that price or higher? It's the same, sell limit. If you're doing a bullish trade, your target is almost always a sell limit. Now, number 2 here, I saw a big, huge bullish candle here, and I want to buy if it pulls back to this price. How do you tell your broker, hey, I'm putting this order there, but I want to wait for it to pull back to this price and then fill me at this price or lower? That's a buy limit. And then again, if you're wrong, and instead of pulling back to your buy price and then bouncing like we see here, what if it continues to tumble on down? I don't want to lose big. I'm willing to lose 1R, but not more than that. So I want to sell, but not until it gets to this price or lower. That's a sell stop market. Now let's go over here to order here number 4. You want to buy at the purple price or lower. You can put an order out there and say, hey, buy when it gets to this price or lower. That's a buy limit. If you see this big bearish candle just bust through old support and you're thinking, man, that's going to become new resistance, and I want to sell if it comes back up to that resistance, you can put this order out there. What type of order type is that? If you want to wait for it to come back up, and when it hits a certain price or higher, sell. That's a sell limit. And then your protective stop. You don't want to buy to close, or maybe it's buy to open, but in this case, buy to close. You don't want to buy until it gets to a certain price or higher. That's a buy stop market. All right, back it up, practice those, understand. I'm going to keep going. Here's where all the magic happens. We're going to take all those order types, put them together. There's something called, that no one calls it OTOCO. They call it OTOCO. That stands for order triggers, order cancels order. Every broker has a different term for it. It's like it's trademarked or something. But basically, you can put your entry, your stop, and your target all at the same time. All 3 orders, all at the same time. When the entry fills, when you get triggered in, then the market maker, the broker immediately enters your protective stop and your target. So you got 2 orders out there, your protective stop and your target. When one of those fills, either your target or your protective stop, it cancels the other one. So you can put all 3 in at the same time and walk away. So let's say you see this shape on the left and you're like, man, if that pulls back to this old resistance, which I think is going to be new support, I want in. But I'm going on vacation and I'm not going to be around my computer. I don't want to watch my phone because I want to be on vacation. So you put in your entry, your target, and your stop, and you will go on vacation. And maybe this happens. Maybe it triggers you in and rolls on down to your protective stop. Okay, you only lost 1R. And when you lose, if you lose small, and when you win big, you're going to come out ahead. I saw this shape one time when my wife and I were going to Puerto Rico. This is when I was running a day trading. It was mostly day trading, but I was on the webinar live at least 3 days a week, sometimes 5, trading my own money, taking people's requests. And I saw USO. And I said, hey, if it breaks through, I want to get in. And I actually got in with options, not shares. But I put in my order to buy stop, said, hey, look, if the price gets up to, I think it was 10 cents on the option I was buying, I want in. And I had my target and I had my protective stop. In this case, my protective stop was 0, which you don't really need, but let's just say that's where I had it. And then we get on the plane and we're in baggage claim and my phone goes ba-ding because I got triggered in. And my wife's like, what was that? I was like, we got triggered in on US oil. And she's like, why are you trading? I'm like, honey, I placed this trade like a few days ago. She looked at me like, what are you talking about? And then we were drinking umbrella drinks by the pool at the Ponce Hilton, and I got that sound again. But she's like, are you trading stocks? I'm like, honey, you see me? I'm here. My phone's over there. Well, it hit the target, and we tripled up, and I never looked at it once. I mean, I looked at it once to see this breakout pattern setting up. I put my order, went on vacation, it entered, and it hit my target. Yeah, sometimes it hits my entry and it hits my protective stop and I lose. But that was probably one of my famous trades, one of my most favorite trades, because my wife got to see this new fangled magic of trading stocks and not being around a computer or a cell phone. It was awesome. All right, you can do the sell with the sell limit entry. You put all three in at the same time. And when you get triggered in, the stop and the target go live. And realize if it gaps over your target, you would actually get filled down here. Even better. That's why we love buy limits, because buy limit says you can get filled at your price or better. Sorry, the limit entries, you can get filled at your price or better. And you can also have all three if you're doing a bearish breakdown trade. All right, study those. They are really super cool. Now there's another way. Instead of just placing your stop and leaving it there, you can do something called a trailing stop. Okay, so a trailing stop basically says you can do it by percent or dollars, but you tell your broker, hey, I always want to be $1 or $10 or 5% lower than the recent high. And then what the broker will do is when you get triggered in, imagine this black line or navy line, whatever that is the price of the stock. And this dotted red line is the protective stop that the broker is doing. And notice how the broker raises the protective stop automatically as long as the stock is going higher. When the stock stops going higher, the protective stop does not go down. It just stays there. Is it going to get filled or is it going to bounce? Well, when the stock starts setting higher highs, the protective stop goes up. But it stays flat when the stock is going down. If the stock goes up fast, the protective stop goes up fast. If the stock is going down or sideways, the protective stop stays the same. Once the stock starts going above the previous highs, again, not all-time highs, just highs from when you got in. If the stock goes up slowly, your protective stop goes up slowly. And eventually, you will get triggered out. Now, some people like this, some people don't. Folks, this is a manual drawing because I couldn't get AI to do anything that I liked. So, if AI cannot create a good drawing, you're getting into some advanced concepts. This is something you need to practice. You're not going to master this skill just by watching a video that's going through this stuff really, really fast. You got to talk to people, talk to experts, reach out to me on social media, and practice this with fake money. I'll show you how to do that on May 6, 2026. That'll be episode 8. For those of you that are watching this in the future, go back to episode 8 on the YouTube playlist. But I'll show you how to practice this with fake money, practice this skill, but get in a circle of people. Maybe I've opened up a coaching program by then or a community where you can be around people that are doing this. If not, go find a circle of people that are doing this, studying this, or want to. All right. There's some verbiage here on the slide. It is biased towards bullish trades. Realize you can do this on a bearish trade also. Many brokers can do a trailing stop on a bearish trade. Now, I don't like bearish trailing stops like that. Let's see. I was talking with my buddy Sam actually last night. This was the one we practiced on. How would we have used a trailing stop on this section of Amazon stock? So, and I had better drawing tools. Let's see what I can do over here. I don't think there's like a marker tool. Would be nice if I could just draw on the screen. I'll try and figure that out for next time. But when I'm doing this on Zoom, I have those annotation tools. I'm used to those. Let's say we're looking at this thing over here. We see this double bottom pattern, and then we see this massive gap over a resistance line, and we say, ooh, that's going to become new support. And so we put in a buy order. We put in a buy limit order here to say, hey, look, if this pulls back to this level, I want to buy. So I'm going to mark that green. And if I'm wrong, I want to protect a stop underneath that candle. Down here below these moving averages. And so I'm going to mark that one red. And then I'm looking for what's a good 2-to-1 reward risk ratio. And I'm a little bit concerned about this here. This old resistance might be in resistance again. So maybe I can put, I'm going to get a little advanced on you here. Maybe I put a small exit. Oops, not that one. I got it again. How do I get this red line? I want to turn that one purple. What if I put a small exit here? Maybe 50%, maybe 10%, but I'm going to exit some as we approach that resistance. And in order to get the good asymmetric risk reward, that I'm looking for all of my trades, I want to exit if it gets up to this second resistance. Now, if you're saying, Brad, you can see what it's going to do. This isn't cool. You can see what happens in the future. Darn right I can, but this is how I practice. But on this day, this is the order I would put. I would put a buy limit here. I would put my protective stop here as a sell stop market. I would put a sell limit up here. And my brokers right now do not allow me to have two targets in an OTOCO. So I would probably manually put in this sell limit, or maybe I'd watch it and just see what happens. But what does happen? It gapped up, it comes down, it fills me here, and it comes down a little bit lower, and then it catches, this is the 20 exponential moving average, and starts moving in my favor. That's what I want. Hey, look, there's a higher low. It broke that higher high. This thing's working. It's moving in my favor. I'm going to trail my stop. So probably when it gets up into here, challenging that old resistance, I'm going to set a new stop underneath that candle. So I'm going to trail my stop up to there. And then it comes into this resistance. Oh gosh, it didn't trigger me. And it made a higher low. It made a lower high. Yikes. Now it's made a second lower low. It's not a trend yet. It hasn't made a third lower low. But at this point, I'm starting to think that I might be wrong. I'm definitely setting a target here. And I'm also going to raise my protective stop because this is working against me. I still have the 200 simple moving average and the 100 simple moving average as support, along with this blue pivot line that I've drawn, but I don't want to lose big. So I'm going to raise my stop. I'm going to trail my stop underneath this pivot, underneath that candle. So I'm going to put another one right about there. So I'm trailing my stop as the stock goes higher. I'm just doing it manually. Boom, it went up. Not only did it go up, but it gapped. See that gap there? I got filled at the open of this candle, which is above this target. So when it does that, I definitely don't want to lose on this trade. So I'm going to lock in and trail my stop. I'm going to have it above this low there because that tended to be strong support, at least for this trade, and it broke higher after that. So my view is if it breaks down from that, I am going to be very aware. And one thing I'm noticing right now, see that bullish candle right there? Look at the volume on that one. A whole bunch of buyers just came in. A bunch of buyers came in. So let's keep an eye on that one as it goes higher. So it made a big move. A bunch of buyers came in. It's going sideways, right? That's typical after a big move. Hey, I'm getting a higher high. I'm getting higher lows. I'm going to raise my stop again. Let's say I'm going to raise it to the bottom of that one. And right now I am winning. I'm probably doing it on one of these three candles. Let's just say I'm doing it over here. That way I can be below that 20 moving average. So I've got this old resistance as new support. I've got the 10 moving average in my favor. I have this 20 moving average in my favor. All of these things acting as support, and it goes on up. And if I didn't get triggered on that wick, it got really close to my target. This is when I want to start locking in whatever flavor of a win I can. I'm probably going to, if I didn't get filled there, I'm going to raise my protective stop to underneath that level. And now I have a nice tight bracket. It's either going to trail me out for a profit or it's going to hit my target for a profit. In this case, it hit my target for a profit. And again, this is all completely hypothetical. Don't get hung up on the fact that I can see what's going to happen. This is an example of how I would trail my stop. Okay, I would do it manually based on the stock making higher highs and higher lows in my favor. If it starts making lower lows and lower highs against me, I'm going to play defense. Okay, so I like to do trailing stops manually based on the action. Folks, another thing I want to call out before I get off of here. See earnings? That blue thing means there was an earnings announcement, and see how a stock can jump massively over earnings? Do not hold over earnings without, oh, I could have just done that manually. All right. I'm trying to get rid of some of these, but it looks like it's going to be some work. All right. Realize that if my protective stop is this red line here and I'm still in, for some reason I didn't have that target, or that target I had was up there for some reason, I'm still in. Over earnings, it gapped down. I did not exit here at the red line because my red line is a sell stop market. What that tells the broker is as soon as there's a price, as soon as there is a bid below that red line, get me out the next market offering. When the market opened after this earnings, it opened down here and I got filled way down here. So over earnings, if you're doing a short-term trade, close out. I would have closed out on this day. If it had not hit my target, I would have closed it out. At some point during that day, I would not have held over earnings. If I was going to hold over earnings, I would have had a put for protection. All right. That's how I do trailing stops. That's the lesson for today. Learn the 3 order types, learn how to put them all in together, and learn how to trail your stops. Again, learning means acquiring the skill. To acquire a skill, you can't do it just by watching this video. You have to practice. On episode 8 on May 6th, I'm going to show you how to build a trading plan that will include back testing and paper trading. Those are expensive words for practicing. So find your circle of friends that you're going to work with, discuss it and practice with, and do it together. That is how you learn a skill. All right. Control your money mindset. And one way to do that is to be around people that are seeking financial freedom. Calculate your desired rate of return. If you don't have that link to the calculator yet, is in the description of this video. Structure a portfolio that follows Ray Dalio's principles of having investments that are diversified, non-correlated with asymmetric risk reward. I'm talking about stock market right now. All the stocks, all of the stocks, I'm going to say it again, all of the stocks, the technology stocks, the real estate stocks, the banking stocks, the commodity stocks, the service stock, whatever the stocks, all stocks are 80% correlated. So you cannot be 100% in the stock market and be non-correlated. It doesn't happen. Public equities, all of the public equities, anything that you go buy and sell on a public market, those are 60% correlated. So I was talking to someone yesterday, and they said, Brad, we got a 401k and we're diversified. You might be diversified, but you're not, but you're 60% correlated or worse. So this is why we got to get outside the stock market to get non-correlated. Get investments that are diversified, non-correlated, with asymmetric risk reward. If you win, you win big. If you lose small. That's what asymmetric risk reward means. Peter Mallouk helped me put all this together by realizing you can accomplish this non-correlation magic piece by getting outside of the stock market. So The majority of my target for my portfolio is in real estate. I do have a majority in real estate. I want a little bit more than I have right now in private equity. Stock markets, for my target is to have about 15% of my investments in stocks, about 10% in energy. I am pretty close to that right now. 5% in alternatives. I do have that right now. So right now my portfolio is a little bit heavy in real estate, a little bit light in private equity, but everything else is pretty well balanced the way I want it. But realize that almost 80% of this is in private investments, not public. Also make sure that your portfolio serves your need for cash on cash and equity growth based on your current lifestyle needs. Indomitable Horizons Fund has investments open now in April 2026. We have private investments. And if you want to learn about it, go swing over there. Folks, how we learn. Have I said this before? It's only 10% by reading and listening and watching a video. You're not going to get the skills you need to achieve financial freedom just by watching this video, but it's a great start. At least I hope it is. You're going to get that skill 30% by having a tribe of close friends that are doing this with you, where you can discuss and practice with them. Folks, follow me on social media for updates. Ask me questions. Keep coming to these videos. Keep coming to these live sessions. And tell me what your stock is. What's your favorite stock? And we can go practice on your favorite stock together. We can look at it live. I'm happy to discuss how to apply these techniques to your favorite tickers, but you got to come live. So if you're watching this and you're not registered yet, there will be a registration link in the description box. Thanks for watching this video. Thank you for coming to these sessions. And I wish you nothing but the best. Financial freedom, peace, and happiness. And always, folks, trade on logic, not on hope. God bless you.